Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dominic Chu. From a new Fed chair nominee to a hard turn to risk-off trading in some parts of the market, the broader landscape is rapidly changing for ETF investors. Joining me now is Joanna Gallegos, the co-founder and COO of Bond Blocks, alongside Todd Sohn, the technical strategist over at Strategic Securities. Thank you both for being with us this afternoon here. I'm going to start a little bit with you, Joanna, just about what the state of the market is like in your mind, given the fact that we have a new Fed chair nominee. We have interest rates behaving somewhat well over the course of the last few weeks and even months at this point, and a market that seems to be trying to figure out where the next step is going to be. What exactly do you make of all of this in confluence with each other, Joanna?
Well, I think we still see resilient economy. We're seeing through earnings reporting that companies are still faring well. The fundamentals on their balance sheet still strong. Interest rates, the yield curve looks like it's steepening, behaving appropriately with rates on the long end being higher than the rates on the shorter end. So that feels like a lot of normalization, but the markets are highly, highly responsive right now to all the news that's coming out. I think there was a waiting period in January to understand exactly what the direction was going to be with the new Fed chair. But so for year to date, there's some really strong performance in fixed income. Surprisingly, the best performing area in fixed income year to date and also last year was emerging markets. So it tells you a lot about investment and looking outside the U.S. for other opportunities too.
Joanna, how much of that trade is based upon not just the idea of diversification or mean reversion, because they have been underperforming other parts of the credit market and overall rates market for a while, and how much of that is this kind of feeling that there is a de-dollarization or some kind of a movement away from dollar-denominated assets because of what's happening here in the U.S., not just from a policy perspective, but from a sentiment perspective as well? Well,
the U.S. trade is not going away in terms of issuance across the board, corporate, government. You know, the U.S. has the strongest fixed income market. It's the biggest opportunity set for the world to continue to invest in. It represents a lot of stability and a lot of known quantity in terms of the way corporations and the government are able to be available to everyone. But the opportunity set outside the U.S. is also very important. And so I think there could be the dynamic of, you know, the dollar putting pressure, the dollar pressure putting more of a view on non-U.S. assets. But the truth is, I think people are just seeing the returns from last year and looking for a way to take advantage of those opportunities more so than anything else.
Todd, do you feel the same way about this idea that we could start seeing a little bit more of a move away from some of these kind of U.S.-centric assets towards other parts of the market? And how much of that do you think is being driven by sentiment from a flow perspective? Are you seeing that play out on your side?
We are. And I think this has a lot to do with the way U.S. indices are currently constructed, right? It's no secret that you have a little bit of a concentration problem in the United States. Now, yes, some foreign equity markets are more concentrated at the top than they are for the United States, but think how much money tracks U.S. assets. So that's a lot of wealth tracking a small cohort of names. And so I think you're seeing this diversifying away from the U.S., not necessarily selling U.S., but going back into emerging markets. Like Joanna mentioned, there's a lot of good risk return there, whether it's in equity or debt, because frankly, those assets really have not worked for about a decade. So I think investors are getting smarter. They're sticking with the U.S., they're going to EM, they're surrounding with themes and all the myriad ways to play income in the ETF world. So the flow is definitely back up this idea of looking abroad, looking at other alternative ways to keep portfolio returns going.
Todd, where exactly from a flow perspective and an ETF perspective are you seeing some more of this activity when it comes to the income orientation? Is it still kind of in that traditional dividend-paying stock type thing? Are more flows going towards bond-based ETFs? Are you seeing more of these alternatively, I guess, actively managed alternative income instruments that are meant to spin off income? How exactly are people playing that kind of a trade?
There's a really interesting dynamic that's happening. Over the last 3 years, flows to option income ETFs, right? The ones that sell covered calls to generate income and try to keep some upside on the equity sleeve. They've outnumbered flows compared to dividend ETFs, right? And dividend ETFs were great in the QE era when fixed income rates were depressed. And so you had to reach for yield. Now you can get that yield from a lot of these different option strategies. And so they're about 25% of dividend ETF assets. And I think investors like that they're getting some upside, they're getting the option premium. There's different tax consequences for that. And then I also would throw it out in the fixed income space that money market funds have dominated flows for the last few years. You now have rates dripping lower. We'll see if we get 2 or 3 cuts this year. And I'll leave that to Joanna and her team, what they think. But that's a significant amount of money that's sitting in money market funds, $8 trillion in assets. We believe that as cuts come, that money is going to get deployed to fixed income products, whether it's active, whether it's out on the duration curve or different types of credit. Massive opportunity for fixed income ETFs to continue to take share.
All right, so those, Joanna, because we are, since Todd broached the subject, we are going to defer to you this one here. Those bond-based funds, whether they be mutual funds or ETFs, have long been investment instruments and vehicles that people have turned to for that kind of regular paycheck, whether it be on a monthly or a quarterly or a yearly basis. Where exactly then are you seeing some of the best opportunities within that fixed income space, traditionally speaking? We can talk about derivatives and structured products like Todd is saying for some of these other strategies, but traditional bond funds, whether they're in emerging market or otherwise, are now places that people maybe have more relative comfort. So where exactly do you feel that there are opportunities within that relative comfort of bond funds?
Yeah, I hope they feel very comfortable with the income that's back in fixed income since 2022. People were reaching for yield and looking for income to offset volatility for almost 2 decades, once rates sort of went back to zero after GFC. So that advent of more income back in fixed income has been really important in the last 4 or 5 years. So the places that we think investors should be focusing on is credit, in particular investment grade credit. But to be smart about how to use that, you should be moving yourself out on the rate spectrum to BBB, because there's a yield advantage to going out to BBB with basically the same default risk of investment grade, which investors have come to expect rarely, if ever, defaults. So in terms of that safety, locking in or getting exposure to that income dynamic is where we would say you should be. And to be an intermediate right now, because the expectation is, well, we had a zoom up in rates, which is great for income to offset the volatility in your portfolio. We do think rates are going to come down, so now the price appreciation of your bond portfolio is going to come into play versus what people experienced was the interest rate exposure before. So as interest rates come down this year, intermediate we think is a great place to be. It was in the fourth quarter. The intermediate space outperformed most of the other categories across the spectrum in fixed income. So intermediate credit is where we start with. We also like high quality private credit. We think that for what exactly investors are trying to do, they're trying to reach for yield, but they don't want to take on as much risk. So if you're transitioning from that money market space, yet you want to get as much yield as possible, we think you should be looking at private credit. So our product in private credit is right now, it's yielding close to 7% with a duration of almost less than a month and a credit rating in that portfolio of average of A. So it's really important to utilize some of these products that are in the market now. They really can be powerful. I think people like to use some of the derivative products to offset their equity risk, but we want to remind them that the income is back in fixed income, and bonds are not just necessarily the safety part of your portfolio, but also the opportunity and the income set as well.
Todd, some of the stuff that's kind of resonated with what Joanna is saying has been with investors in ETFs who are trying to figure out ways to enhance that yield. Have you seen any signs of stress in your mind with regard to maybe possibilities for concern down the line because of deteriorating credit quality? Is the economy flashing some signs that maybe things are slowing down a little bit? How exactly does the macro picture shape up, given what we are seeing in terms of a tilt towards income strategies? And do those income strategies then have to be a little bit more closely scrutinized because of some of the macro factors at play right now?
Yeah, I don't necessarily see stress. I mean, credit spreads are still on multi-decade lows, whether it's high yield or investment grade. Financial stocks, specifically the banks and some of the capital market names, still are okay, right? If you look at big bank ETFs, that's a pretty good barometer of how the market might reflect the economy. I think the one stress point that stands out are private capital stocks, right? The public PE and private credit type names seem to be having some trouble, and there are headlines that are out there of private credit funds being marked down recently, which is where I think the ETF, like PCMM that Joanna has, comes in handy, where it's transparent. You can figure out what the holdings and the ingredients are in this thing. They're all properly rated. And so I think if you're going to see any further stress, maybe it shows up there, but so far that's okay. It looks a little bit more, I don't want to use the word contained, but that seems to be the stress point right now, is these private capital type names and the less liquid vehicles that are out there, as opposed to, say, in the ETF space. If you wanted to see in the derivatives what's going on there, I would kind of pay attention to what some of these metal names are going on. How long do they trade at a premium or discount for going forward? Because that's where the action is, but that's completely unrelated to what's going on here, for what that's worth.
Sure, Joanna, I mean, the private credit side of things has been focused on for a couple years now, but it's been around for a long time before that. It's only recently, in the last few years, that it's come to the forefront because people have been able to invest in it through fund formats or through ETFs. Is there, in your mind, a education or knowledge gap with regards to people who are investing in traditional bond funds, whether they be on the rate side of things or investment grade corporate, and then kind of making that move to reach for a little bit more yield in private credit? Are there things that you feel as though maybe aren't being appreciated about what you need to understand about private credit investing that some investors don't know, and all they see is the higher yield that they might get?
Yeah, I think the yield is attractive, and that's a good reason to look at private credit. The reality is that more companies are private than they used to be. So 20 years ago, even 25 years ago, there were maybe 8,000 publicly listed companies. Now that's down to 4,000. It just means that the full opportunity set isn't available to you unless you look over the fence into private equity and to private credit of all of the American companies that you're able to invest in. So that's an important thing. That's why you should look. The yields are very attractive. But one thing that I think people need to understand about the structures in something like PCMM is, that it's a very well diversified exposure to private credit. So it holds CLOs that are bonds that underline loans, of direct loans to companies. But what's in there is there's also multiple managers. So what you're seeing in the press is you're seeing maybe a fund of one manager and one manager's assets being marked down, and that's going to happen. There may be a concentration in that manager's approach or in the loans in the companies that are in their fund. In something like PCMM, because of the way it's structured, you're getting exposure to almost over 7,000 of those loans, and there's 27 different managers in that portfolio. So the immense diversification, it seems to be the right approach in an ETF. It gives you a pure play to private credit because 80% of the exposure in that product is private credit. And I think there's been a lot of discussion about other vehicles and ETFs that there may not be 100% private credit. So if you're really looking to get the full opportunity set, reach for those yields with the risk characteristics I described, I think that it's important to start engaging with private credit and not be so trepidatious about what you're seeing in the headlines, because you should be looking for something that gives you access to the whole broader exposure.
All right, Todd, with that in mind, given everything that we've now seen, we talked earlier at the top of this program about this idea that we have a changing Fed landscape coming up. Interest rates, I'm not going to say that the forecasts are all over the board, but, they've kind of tightened up a little bit and maybe gotten a little bit more clarity with Kevin Warsh being named as the nominee for Fed chair. I wonder, from your perspective, how you think the investing landscape for you is either changing, shifting, or evolving over the course of the next few months, given this idea that the Fed is going to be a little bit more variable, I guess is the best way to put it, over the course of the next several months.
Yeah, I think from the equity landscape, I would expect more volatility, right? So you're going to have a new Fed chair. It's also a midterm election year, and both of those historically bring volatility. It's just how markets play out, right? There's a lot of different variables at play. So I would definitely be looking for volatility. I would think low vol strategies might actually make a comeback here, and those have seen pretty good outflows over the last few years as there's been other replacements in those portfolios. So I think if you're looking in the equity sleeve of your portfolio, take a look at low vol to help ride the storm out. And then in fixed income, Joanna says, and she's right, the income is back in fixed income, whether it's the 2-year, the 10-year, and yeah, the shorter end is dripping lower, but You can start to move out on the duration scale, and you're still going to get a pretty good return there without any sort of credit blowups, I think, that are out there. So I think investors should just realize, hey, if you're too much in the short end, consider moving out on the fixed income space. You can capture that yield and look to say, how can I hedge myself throughout what is expected to be a pretty volatile year, given all the policy variables that are out there going forward.
All right, and Joanna, because you are the bond manager on this panel right now, from a bond manager's perspective, what exactly are you thinking mentality-wise or construct-wise about how you're going to approach the balance of this year, knowing that, to Todd's point, this is a midterm election year, knowing that we have a new Fed chair coming in, whether that's Kevin Warsh, the nominee, or some other strange development down the line? Do you have to kind of change the way that you look at fixed income markets given all of these potential catalysts? Or is this more of a business as usual environment until you see evidence of something actually happening?
I think if you've been, steeped in fixed income as we are every day, you do see the bouts of volatility, you do see the uncertainty coming through in the appointment of the Fed chair. But what we see is a lot of consistency. So for 2026, our outlook isn't much different. But what we do, which is sort of very much a Bond Blocks way, is we just help you get more precise during a year like this year. So we still see that credit fundamentals are very strong. Spreads are tight, which also means really means that the economy is strong. There's still really attractive yields and income, as Todd mentioned. So you should be using more fixed income. We like credit. We do like the international exposure this year to help, move people towards, a more diversified portfolio, but also capture some of the attractive yields that are developing there. As we mentioned, it's important to look at the full opportunity set. So private credit, so public and private credit is something we want people to look at. So I wouldn't say that we haven't seen defaults. That's been very consistent. But the resiliency, the strength of the economy, and the income, we've been telling that story in 2023, 2024, 2025. The mix is a little different, but there's a lot there still for opportunity.
And Todd, before we let you go, the one thing that could derail what's happening in the markets right now, in your mind, in the next couple of quarters, what would you be watching out for?
A credit event. If any of this private credit in the illiquid space starts to leak into other areas of the financial system, I don't have any edge on that, but that would be my, kind of the glaring sign of risk I think that's out there. Quite frankly, everything else so far seems all right. Credit spreads are still okay. Banks are still okay. The consumer seems all right. But I think it would be some sort of credit event out of left field that leaks into other areas that we're not maybe focused on.
And Joanna, same question to you. What exactly would you be keying in on from a data perspective, a macro perspective, or anything else with regard to whether or not something does maybe happen badly down the line?
I think we have our eye on credit events. I think we also think about, as I mentioned, the diversification. It's hard to say. We had a huge credit event with a bank failure 2 or 3 years ago, and this economy absorbed that. So I don't know that a credit event would be on our top list. I think we want people to be paying attention to the risk in their portfolio and adding as much income as possible. I think on the side that we've seen investors take probably too precariously time and time again is going too far out on the curve into the 20-year too fast because they think that rates are going to come down very quickly. That can be not the best trade, and it's been really volatile for investors time and time again in the last 4 years. Or just piling back into equity. Equity risk seems to be a huge appetite for the U.S. investor, and not offsetting that risk. Once you get through some comfort level, there's a dip or there's a market volatility, we see investors just go all the way back in. So not being more balanced there and diversifying your risk is what I actually think is the risk, not necessarily an event.
All right, interesting conversation for sure. I want to thank Joanna Gallegos and Todd Sohn as well for joining us here. We've asked Todd to stick around for the ETF Edge podcast. You can catch that and all of our other content over at etfedge.cnbc.com. Thanks for watching. We'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.